Welcome back to the Deep Dive. Today, we are strapping in for a ride through the Q3 2025 earnings call for Six Flags Entertainment Corporation, ticker symbol FUN.
And FUN is probably not the word the market used to describe it.
Not at all.
Yeah.
This was the first full period after their huge merger integration, and our mission today is pretty clear. We have to unpack some serious financial volatility.
Extreme volatility.
We're talking a historic earnings miss, a massive strategic pivot management is now scrambling to make, and of course the entrance of a very high-profile activist investor.
Right, and just to set the stage, the reaction to these numbers, which dropped pre-market on November 7th, was, well, it was brutal. The share price slid immediately. It set a really cautious, almost alarmed tone.
Okay, so let's get right into it. Give us the top-line summary. What were the numbers that spooked the market so badly?
All right, so let's start with revenue. It came in at $1.32 billion.
Which was a miss, right?
Yeah, slight miss, yeah. Expectations were for $1.34 billion, so that's a 2% decline year over year. Concerning, but, not a disaster.
So that wasn't the headline grabber.
No. The number that caused the real shock, the one that everyone was talking about, was GAAP earnings per share. It was a loss of negative $11.77 per share.
Wait, say that again. Negative $11.77.
That's right.
The consensus on the street was for a positive $2.18. That's a nearly $14 miss. To the listener, that sounds like a company on the brink of collapse.
It absolutely sounds catastrophic on the surface, but this is where you really have to look under the hood. That huge GAAP net loss, which was about $1.2 billion.
Okay.
It wasn't because of cash flow just, bleeding out of the parks.
Oh, what was it?
It was almost entirely driven by a colossal one-time non-cash impairment charge of $1.5 billion.
$1.5 billion. Okay, let's pause there. For everyone listening, what exactly is a goodwill impairment charge and why is it non-cash?
So goodwill is basically the premium a company pays for an acquisition above the value of the physical assets, like the roller coasters and the land. It's for intangible things, like brand reputation.
Got it.
When management writes down $1.5 billion of that, they're officially admitting those intangibles aren't worth what they thought they were. It's an accounting cleanup. But, and this is the crucial part, no actual cash leaves the building.
That distinction is absolutely key. So if we strip out that accounting noise and look at a real operational metric like adjusted EBITDA, the picture is very different.
Exactly. Adjusted EBITDA came in at $555 million, which is basically flat year over year.
So operationally, the business is stable, but it's stagnant. The real story here isn't the accounting shock, it's the failure to grow.
Precisely. The story pivots from the balance sheet to the operations.
All right, so let's follow that thread. Let's look at the cash flow story. They did manage to grow attendance by 1%, up to 21.1 million guests. On the surface, that sounds like a win.
It's a win for volume, but they paid a very steep price to get it.
How so?
Well, to get that 1% bump in people through the gates, they had to just slash their pricing power. In-park per capita spending actually declined 4%.
4%. And what about the ticket itself?
That's the really telling number. The admissions per capita, so the actual ticket yield, it dropped a staggering 8%.
8%. That just screams heavy promotions and deep discounts. They basically gave away tickets to fill the parks.
That's pretty much what management admitted to. They pushed too hard, too fast with pricing changes after the merger. The only bright spot was out-of-park revenue, like sponsorships and rentals. That was actually up 6%.
But the core business, selling tickets to ride roller coasters, is under serious pressure.
It is, and that leads us right to the heart of the problem they laid out on the call. They called it the tale of two cohorts.
The operational split. This is the central theme, right? Unpack this 70-30 split for us.
Right. So management was very candid. They said that roughly 70% of their year-to-date park-level EBITDA came from what they call their outperforming parks.
These are the flagships, the winners.
Exactly. And in that high-performing group, the results were genuinely strong. Q3 modified EBITDA was up double digits, and attendance in just that cohort grew by 5%. It proves the new model can work.
But the flip side of that coin is The other 30% of the parks, which are dragging the whole company down.
They're a major drag. These underperforming parks saw their Q3 attendance go down by 5%, and this is where the margins just got crushed.
They gave a specific example, didn't
A
they?
really painful one. They took two parks that started the year with similar margin, around 43, 44%. The outperforming park actually grew its margin to 47%.
And the struggling one.
Its margin collapsed. It dropped from 44% all the way down to just 29%.
Wow. A 15-point margin drop in a single quarter.
Oh.
That feels like a catastrophic failure of planning.
Yeah, it was. And they were brutally honest about why. They said they deliberately poured money into maintenance and labor at those parks before the demand was there.
So they were trying to improve the guest experience, hoping it would justify higher prices.
Right. But the people just didn't show up fast enough to cover those costs, and it led to what they themselves called an unacceptable result.
So this is the shocking the market that they admitted to.
It is. They were very self-critical. They said they moved too fast and too far on pricing. It's like they tried to turn a regional park into a premium destination overnight, and they just alienated their core customers who were used to discounts.
And now they have to recalibrate for 2026.
With better data, hopefully. But this problem got worse as the summer ended. They flagged demand really softened in September and October.
October was down 11% year over year, I saw.
It was, though they did stress it was up against a perfect weather October in 2024. Still, that softening was the final nail in the coffin for their guidance.
All right, they had to cut the full year guidance for adjusted EBITDA pretty sharply, down to, what was it, 780 to 805 million.
That's right. And you have to remember, their initial guidance back in February was aiming for $1.1 billion.
That's a $300 million shortfall from their own expectations. That is huge.
It is. And the CFO basically said the majority of that miss came down to one thing: weaker than expected attendance.
So you have a struggling stock, high debt, and a key part of your strategy failing. That's a perfect storm for an activist investor to show up.
And that's exactly what happened in a huge way. JANA Partners, a very well-known activist firm, disclosed a nearly 9% economic interest.
In collaboration with Travis Kelce.
The football superstar. I mean, you can't write this stuff. It immediately became a massive media event.
That kind of free publicity must be invaluable, especially with all the negative sentiment. How did management respond to this?
The CEO, Richard Zimmerman, who's on his way out, actually called the engagement constructive.
So not hostile.
Not at all, at least publicly. They're leaning into it. Zimmerman said they plan to capitalize on the Celebrity Brand Association for the 2026 season. It adds instant cultural relevance.
Okay, so a new CEO search is underway under a lot of pressure. Let's talk about the path forward. Are they actually making progress on the integration and the tech side of things?
They are, and this is really the key to the long-term story here. They've standardized safety protocols. They launched a single unified website. But the two big ones are these.
Go on.
All parks will be on the unified Tickman ticketing platform by the end of this year. And a single ERP system that's for all the financials and planning is rolling out in early 2026.
And having that unified tech is what they need to avoid the pricing shock of this year, right?
It's everything. In 2025, they were flying blind. They couldn't do sophisticated dynamic pricing across the whole portfolio. This new infrastructure will let them move from blunt discounts to smart, targeted pricing like you see with airlines. That is the key to unlocking value.
That's the foundation. But what about the parks that are just dragging them down? The 30%.
That's the other big move, almost certainly pushed by the activist pressure. They're moving with urgency to review the whole portfolio.
So selling off the underperformers.
That's the goal. Divest the parks that are only generating low single-digit millions in EBITDA. That does two things. It helps pay down their nearly $5 billion in debt, and it lets them focus all their capital on the 70% of parks that are actually working.
Trim the fat. What about leading indicators for next year? How are season pass sales looking?
They're cautiously optimistic. Sales are pacing up 3% in dollar volume.
That's good.
But it's on 5% higher pricing, and they've sold slightly fewer passes, so it shows they can get a higher price, but they need that new tech to really dial it in and maximize both dollars and the number of guests.
So to sum it up for the listener, this is a company in a massive transition, moving from a messy, discount-driven recovery to, hopefully, a more disciplined, tech-enabled strategy.
That's the whole story. And despite the ugly headline numbers, they're financially stable enough to do it. They have over $760 million in liquidity. Leverage is fine. This is a turnaround story, not a solvency crisis.
All right. That brings us to our segment, This is Not Financial Advice, where we pitch an outrageous but plausible trade based on what we've heard.
Okay. My pitch is simple. Long Six Flags, buy the JIP on a 12-month horizon.
Wow, that feels bold. After a negative $11 EPS miss and a massive guidance cut, why would you bet on this company right now?
Because the short-term pain is the long-term opportunity. That negative $11 EPS, as we discussed, was an accounting cleanup. That $1.5 billion impairment charge. It wipes the slate clean for the new CEO. The risk of another big accounting shock is now mostly gone.
But what's the outrageous driver here? You can't just bet on a celebrity endorsement, can you? That's just marketing.
Ordinarily, I'd agree. But this is a force multiplier. The JANA and Kelce collaboration provides massive, instant, and most importantly, free brand revitalization. That's the buzz they need to justify higher prices. You combine that celebrity heat with the new tech.
The Tickman and ERP systems.
Exactly. When those come online for the spring 2026 sales cycle, they'll finally have the tools to turn that buzz into real dollars through smart pricing. It's the perfect storm of celebrity hype meeting operational efficiency.
And the plausible exit. What makes this trade work?
The activist pressure ensures they sell off those non-core assets, that 30% drag. Selling even a few of those parks reduces the $5 billion debt load and immediately improves the outlook. You're buying the stock on an accounting-driven dip, betting that brand heat and smarter operations will win out.
A compelling, if definitely outrageous, thesis.
To recap the key takeaways for you, focus on that 70-30 split between outperforming and underperforming parks. That's driving every decision. Understand the impairment charge was a non-cash reset. And finally, watch that tech integration timeline. That is the foundation for the entire bull case.
So management admitted they shocked the market by moving too fast. That leaves me with a final provocative thought for you to consider. How quickly can you really change the public's perception of a regional amusement park's value? Even with a massive celebrity endorsement. Can brand heat and new tech truly overcome decades of discount-driven consumer behavior? That's all the time we have for this deep dive. Thanks for joining us, and we'll see you next time.